Stock's at $18, 17.92. There's 692 million shares outstanding. So for any of you that don't understand how the stock market works, the stock price has no context. It needs context to be interpreted. So just saying a stock is a X, right, doesn't mean anything. It has to be context driven by the number of shares. If a company has 1 share outstanding or 100 shares outstanding, its stock price could be $1 million a share. But if a company has 100 billion shares outstanding, stock price can be $1 a share, and the market cap, which is the product of the two, multiplied is the so-called market cap, or the total value of the company, which should make sense. So the total value of Twitter is about $12.4 billion. For context, you can think of a lot of companies that are worth $10 billion-ish. Most of them are profitable, remember, and Twitter is not. What's a good example of a $12 billion company? Darden. They have about $2 billion cash. The last I looked at it was Q1, so it's going to be nice to refresh on this real quick. They've had stalled user growth, if I recall correctly, but again, it's one of the most powerful platforms in the world. I remember being criticized for using Twitter when I was a CEO. Now you've got Donald Trump using Twitter, so it tells you something. Cash, $3.6 billion roughly. Got to know how much cash a company has. Otherwise, it's hard to interpret the value of the company. Because if a $12 billion company has $12 billion in cash on its books, then the company technically is sort of for free, right? Okay, so they did a convertible a while back. 15, 17. Convertible debt is debt that also can convert to stock. So a very interesting hybrid instrument. Some people trade these exclusively. All right, so I think they have about 300 or 400 million users. Let's look at, let's plug in the last couple quarters of revenue. They've had pretty stalled revenue growth, which is why the market's a little alarmed. But so they hit their guidance almost exactly. No, they beat guidance a little bit. 34. Revenue growth year over year last quarter was 8%, which is not, that's like a mature company revenue growth, but it's not bad. So their ARPU right now is about $7. Their Twitter's making $7 from you every quarter, so roughly $30. $30 from you a year. So that's how much Twitter makes in advertising. You think about that for a second. It's kind of neat. R&D 177,049. I can tell you for a fact that trailing 4 quarters R&D costs for Twitter was $743 million. It does not cost $743 million to keep up Twitter from an R&D perspective. That entire cost could disappear if it were acquired by Disney or whatever. The maintenance R&D costs of a Twitter are going to be pretty reasonable. So if you take R&D out, Twitter's actually profitable. That's kind of interesting, right? So, and let's see here. So if we assume that 8% growth rate, I'm going to assume they keep that 70% margin. The G&A is also easily replaced. A lot of that general administrative could be cut substantially. So you're looking at EBITDA, potential EBITDA. That's earnings before interest, taxes, depreciation, and amortization for you newbies. So let's say average cash flow per quarter of $150 million. That's $600 million cash flow for a year, 17 times earnings. That's pretty good. That's pretty good. Twitter doesn't make money, but I'm adjusting their costs that I think could disappear, and then looking at the cash flow on that adjusted basis. Now it's 17 times EBITDA. Keep that in mind. I'm not taxing that. Of course, I don't pay taxes, and nor should any corporation. Hold on a second while I hit this Flonase. Okay, so let's see. So one of the things that I think makes sense analyzing is ARPU, so average revenue per user. I think we should make a table of ARPU comps, just so we can get a sense of what the potential is. So we can start with Facebook. All right, last quarter. Oh, I haven't updated the Facebook model in a while. I'll do that next. All right, Facebook has about 1 billion-ish daily average users. And their ARPU is also $20 a quarter. Oh, it's $20 a quarter. Twitter's is $7. So that's aspirational, right? Twitter can get there. So Facebook's ARPU is $5 a quarter. Facebook's making $5 a quarter off you. So Twitter is actually monetizing Twitter is actually monetizing better than Facebook, which is kind of interesting. It's the net income of a company is really overlooked. When people talk about PE and stuff like that, it drives me crazy because the net income is an accounting concept. It's a functional concept too, but only functional if you're adjusting that net income for costs that you believe are special. Like if a company is spending $500 million throwing a developer party every year, that should be removed from the net income. It shouldn't count against the company because at any time you could tap the company on the shoulders and say, hey guys, stop throwing that stupid party. And that 500 million reappears. So you should value the company based on the steady state is what I like to call it. Steady state net income. So anyway, so let's see. Per quarter, Twitter is not. What am I doing here? Let's see. I think I'm multiplying by 4 for both companies. Okay, so Twitter is doing $2 in ARPU per quarter, and Facebook's doing $5. So Facebook is monetizing better than Twitter. Its ARPU is over double Twitter's. So I'll take a step back there for a second. So Twitter could conceivably get to the ARPU that Facebook's at, but the question is that ARPU derived from scale? Is it because Facebook has 1 billion? Triple the users, they have double the ARPU. So it kind of tells you that it may not scale linearly if one is a function of the other, but it could also be a function of time spent on the website and things like that. So on a GAAP basis, Twitter lost 96 million. But again, that R&D, that 177 million of R&D is very questionable if you ask me. They somehow pay taxes, even though they lose a boatload of money. It doesn't make much sense to me. And then share count jumped, which also is, I find, quite interesting. User growth only went up 3%. So that's probably, the really scary kind of thing on Twitter. The monthly average users is 300 million. And despite the president-elect of the United States using it as his main vehicle for sending messages to the world, only 329 million monthly average users, and not growing. It was 320 last year, the same time last year. So what the heck is going on? Why can't they get to 1 billion? Is it possible Facebook's overcounting the number of users? Is it possible it's really just an American website? Lots of questions. Stock-based compensation is another weird one. It's overvalued if the stock doesn't go up. It's kind of a weird. It's calculated based on the Black-Scholes model. If you don't know what that is, you should probably spend some time reading about Black-Scholes, 𝗕𝗏𝗰𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀𝗀 distinctive name. All right. So ARPU growth for Twitter has been a little difficult, but they have a little bit of ARPU growth and a little bit of user growth. So 8% revenue growth coming from that. So they're an American company, so they have to pay American taxes, which is a big problem if you're trying to value the company. So let's see here. Average net income, $78 million. Yeah, so let's see. I mean, I've removed all, like, a lot of costs. I've really tried to give them some credit. So you can get down to maybe net income of 488, 22 times earnings. For no growth, that's like, and some like pent up possibility of success. I'm trying to think, is Steve Ballmer still a huge shareholder of Twitter? Can he buy like 5% of the company personally? Steve Ballmer's so cool. I like that he says that he doesn't want to be an investor, but he buys 5% of a company, a huge company, just in his spare time. It's the kind of rich we all want to be, I think. If you guys don't know a lot about Steve Ballmer, he's probably the reason for Microsoft's success, and some people feel it was an obstacle, but yeah, I'm a big fan of Ballmer. I'm a big fan of studying people who have been successful. All right, let's look at Twitter a little bit more. So I'm going to look at the cash flow statement. A lot of people ignore the cash flow statement, but in many ways, it's the most important, one of the most important financial statements. Twitter doesn't subscribe to the quarterly cash flow statement, as many companies don't. In the SEC filings, you have to just give the accrued cash flow statement instead of the periodic cash flow statement, which is a little frustrating for any of you who have done this for a living. You know what I'm talking about. So we'll just quickly add up depreciation. So the stock-based comp is one of these things that I will say, as an investor, CEO, whatever, I don't understand as much as most people. And I guarantee you, if I don't understand it, you don't understand it. I'm not trying to be arrogant here, but I've taken a lot of companies public and so forth, and it's just not really that easily understood. So basically what you do is you give stock options to your employees for obviously incentive compensation. You want them to work hard, you want them to make money. If the stock goes up, it makes a lot of sense. But the problem is, what is a stock option worth? And that's been one of the hardest things to sort of understand. And there's a complicated formula, I'll pull it up on the screen real quick, called Black-Scholes. So it's pretty simple. You take the natural log of, let's see here, the stock price divided by the option strike price. So in other words, the delta for how far away from being in the money it is, or at the money, or whatever. And you add an interest rate, which is nominal, added to the stock price multiplied by itself. So you take the stock price squared, divide that by 2, and then you multiply that by a time function. You divide all of that by little s, which is the standard deviation of the stock price, if I recall correctly, times the square root of the time. So in essence, what you're trying to capture is, this isn't, the call premium is the only, there's no calculus in this at all, actually. It's just it's really a statistical thing. And it's even more complicated than that's just one input into the formula. So you have to do a bunch of gymnastics here. But at the end of the day, what the basic concept of it is, the more time an option has to be in the money, the more valuable that option is. That makes sense. The more in the money it is, the more valuable it is. That makes sense. And for any of you who don't even know what an option is the right to buy, in the case of stock options to give to employees, they're all call options. It's the right to buy a stock. So if someone gives you the right to buy a stock at 20, you say, well, hold on a second. That sounds weird. Why are you giving me the right to buy something? I don't want to buy anything. Well, hold on. If I'm giving you the right to buy my stock at 20 and the stock goes to 30, that's great. That's worth $10. That is basically giving you $10. If the stock's at 10, the right is worthless in essence. Now, it's not totally worthless because there's a lot of time possibility left in that stock. Potentially, it might reach 30 someday. You don't know. So how do you value that? I'm giving this stock out to my employees. How do you really value that as a cost? And then more importantly, how do we treat it as a financial analyst? Because in many ways, those options, if you include them in your dilution calculation, right? You're kind of if you include the stock that becomes the options that become the stock, if you include that in your dilution calculation, you're sort of double penalizing the company, right? So think about that. And remember that options do result in cash coming back to the company. So it's really one of these things that people don't understand that well. And in a case like Twitter, their biggest single cost is stock option expense. So in this case, you really have to understand it. In most cases, it doesn't matter that much. But in this case, it's absolutely critical. So you have to get a philosophical understanding of options. So my understanding of accounting is that for options, you don't include them in shares outstanding unless they're in the money. But I'm not a CFO. I'd always trust my CFO to do that. Sometimes a mistake. But nice guy. But anyway, it's non-cash, but it's an expense. I mean, it's definitely an expense, right? So it's hard to say that it's not an expense. It's clearly an expense. As a company gets more mature, it should get away from stock-based compensation. And what Ballmer said is absolutely right. You know, it is a really good platform. How they monetize it exactly, you know, they are doing an okay job. They're not quite where Facebook's at, but they're not far. It's the number of users that they got to get higher. That's the sort of disappointing thing, I think. You know, how do they appeal to more people? And I think they'll get there. The streaming service, the Periscope, the streaming TV stuff, I think that's a pretty neat way to attract people. I have put ads on Twitter. It's a very easy and fun thing. In fact, I'll do one right now. I'll do an ad real quick on my Lena Dunham. Yeah, if you've read anything about Gates and Ballmer, they had something they like to call the hardcore style of management, that they basically went ham all the time. They didn't sleep, they didn't do anything but work, and they were crazy. So that Steve Ballmer attitude you saw on stage was his attitude in real life. And that hardcore philosophy inspired me. I also like hardcore rap and hardcore rock. So anything I do it to the max. And that kind of philosophy I really enjoyed. So some inspiration to me. And yeah, it doesn't work for everybody, right? Some people are better at being like, and I tried this in my career as well, being a little bit more cerebral, less hard work, more productive work, more insights, more sort of let the employees and the executives do their job, and my job is to be the sage, wise, or sage-wise advisor, or the quirky innovator that comes out with something really astonishing every 6 months or something, like a Jobsian type figure. But I like the hardcore attitude, because at the very least you'll never feel guilty that you're not working. Whereas if you do all those other things, people can't criticize you for not trying your hardest. That's for sure. Especially if you're not making much compensation on the cash side. That's a really good thing to do, I think. I once asked a bunch of my shareholders at Retrophin if they would support a no salary concept for me, and they actually thought it was a bad idea, some of them. That it should get paid something in cash, obviously in stock. I need to get paid something or I'm not going to work. So if you add back stock-based comp, the company is profitable. And that's without taking out the R&D and G&A costs, which are probably reducible. How reducible, we don't know. But let's take a look at the 10Q to see how many total options they have, because that'll be listed in here somewhere. Options outstanding, 6.7 million exercisable. Options outstanding. Okay, a lot of RSUs. Jesus Christ. Okay, 54.6 million RSUs. Weighted average grant date fair value per share $23. That's the current price roughly. So R&D gets the lion's share of stock-based comp. Okay, we kind of cancel R&D out in our model. Yeah, so if it looks like 50% of stock-based comp is going to the R&D department, and we sort of remove that entire department in our analysis, so I think we're still in that same place where it's roughly 20 times adjusted earnings. So the question is, can it grow in importance relative to Facebook? It would seem like it's sort of that concept is skewed to the upside, that there's it's likely that the platform will grow in importance rather than shrink in importance, but it's hard to tell, obviously. And that maybe it's a management problem. If the product's not as popular in the U.S., the product's not as popular outside of the U.S. as it is in the U.S., it's possible that's sort of a management problem more than it is a Twitter problem. It's one of these stocks that is more art than science in many ways, as a lot of technology investing is. The fact that they're profitable right now is very helpful. People always talk about Twitter not being profitable, but it's clear that they're profitable. I don't take insane R&D expense as the core product. The core P&L is there. The messaging apps don't, kind of persist over time. The ICQs, the AIMs, etc. But, WeChat, QQ, I think in China, they've done it extremely well. So maybe that's not totally clear. No, the 37% growth is, where's that? I have like 10, let me see here. I think I was making a point there. Thanks for pointing that out. Okay, there you go. Back to $12 a share. Oops. Yeah, but I have to adjust some other things here. So if you clobber R&D, they have their work cut out for them. That's for sure. But I kind of believe in what Ballmer's saying. I think it's such a good product that even the bad management team, as Buffett would say, can get it right. And I could see them. Instagram, for instance, had this really interesting monthly average user pattern. A couple fixes could really grow the product. So I would not be surprised to see some good years in the next few years for Twitter. But the stock's it's not the greatest deal in the world right now. It's implying that they will have substantial growth and cost cutting, which may not be realized. So I'll take it back. I would not be long Twitter. Oh, if they have negative growth, the company's worthless. That's for sure.